Is TSPY the next SPYI? Why does TSPY exist? How does this fund differ from other zero DTE funds like XDTE, for example? What might future products look like, potentially doing weekly distributions? Was that ever in the conversation? Okay, everybody. Today I'm excited to bring to you Katara of Tap Alpha with a brand new fund that we're going to be talking about today called TSPY. Very excited to talk about this, especially it's right in the wheelhouse of my own personal strategy. So, Sai, welcome to CoveredCall ETF Investing.
Jordan, thank you so much for having me. It's great to be with you.
Yeah, absolutely. So much to get to. So what I'll do is we'll just get the heart of T-Spy right away. This first question, it's a bit of three micro questions, but all kind of bundled into one, and I'll let you kind of run with it. But the first one is, why does T-Spy exist? What problem is it trying to solve, and what motivated you to create this fund?
Appreciate it. I think probably the best way to answer that is to sort of talk about the genesis of T-Spy and where it all came from. And it actually came from a circumstance I had in my own life. So I came from a totally different world. Computer engineer, was a software entrepreneur, and ran actually a construction technology company for 17 years. And I blinked and looked behind me, and half my career was already past. And I was trying to figure out, look, I could stay in this business for my entire career, or I could make a change and try to make impact in other places that I'm passionate about. Finance and fintech has always been something that I've wanted to pursue. So actually, in October of 2022, I ended up leaving the company that I founded to work on the next project, and so figuring out what it was going to be. But in the interim, I had to figure out, how do I make ends meet, from a day-to-day perspective. And then the other component to it that put extra pressure on was, my wife and I were pregnant, and so we were 4 months away from having our first baby girl. And this was sort of a reality moment where you're like, all right, great thinking. I know you want to do something different with your career, but how are you going to make ends meet today? And in October 22, the markets were way down. I was always just sort of an S&P 500 buy and hold investor, but didn't want to have to sell my shares and sort of take a loss with respect to where the returns were. So I remembered a strategy my dad had taught me, and that's what brought me to covered calls. But really, the magic thing that had happened at that time is that same month, daily covered calls, so zero DTE as they're now known in the industry, just became available. And so I was like, all right, well, let me try this and see if it amounts to anything. Fast forward 2 months, and this strategy, just the options income on top, was covering the lion's share of our mortgage. And for us and our new family, like, this feeling of just financial relief and not having to worry allowed me to be present for my daughter's birth, really enjoy. I missed nothing from her first year, which for me is, it's time I don't get back. And I was just so grateful for it. And so I took a look at this, and I was like, it took me a long time, right? It took me 3 to 4 hours a day to do it, just because I did a lot of math before I took my daily positions. And it takes a lot of time. So with the software background, I ended up actually writing myself a cloud-based, tool set to help me do this more quickly. And it took 4 hours down to under 5 minutes. And that, like, was the aha moment where I was like, this feeling I have got to share with other families like ours. And so we're trying to figure out, all right, how do we actually package this value? But anyway, the same month that my baby girl Kaya was born, so was TappAlpha. And we started down this journey to understand, hey, what's the best way to get this to market? So we had two choices. One was release the fintech product and allow people to log in and connect their brokerage accounts to it and have it sort of run this daily covered call strategy on top of whatever security they have.
Mhm.
Or we ended up getting connected with some folks in the ETF industry, and they're like, you should really consider taking this whole thing and wrapping it in ETF. And I was like, that's a brilliant idea, because it really goes to the core of what Tap Alpha is all about. And the whole company was founded on this idea of, how do you provide access to powerful financial tools so that every investor and every advisor can benefit from it, versus things that maybe only Wall Street elites or people that are high net worth can normally have access to. And so ETFs plus technology created this unbelievable accelerator to access. And so that's where we ended up creating our very, very first fund, which is TSPY, which takes this zero DTE strategy, runs the fintech, and delivers additional potential returns in the form of income on top of the S&P 500.
That's a great explanation. I think one of my favorite parts about that, and I think the audience will appreciate as well because it's something that you don't normally get from ETF fund managers, which is um, a tangible use case in their own lives and something that they can share of how it actually impacted them. So you, like you said, you benefited from being able to use this income through cover calls to, kind of support your livelihood while you were off in that transition period. And anyway, I think that's a nice little point that I think the audience can connect with in a way that maybe they wouldn't say normally connect with other fund managers out there. So that I really do appreciate. And I also too, on top of that as well, I think this is sometimes maybe gets lost in the conversation when people are doing that comparison between cover calls on the S&P 500 or just owning the S&P 500 with whatever fund manager it might be, which is the fact that if you own a cover call, say S&P 500, like you said, you don't have to liquidate the actual asset to support your livelihood. You can still have the S&P 500 and generate, a portion of that return differently through the cover call writing. So I think that anyway, like I said, that's a great explanation. One thing I did want to touch on, like the way in which I discovered TSPY, which I
Mm.
don't normally do. So it's great that something I don't normally do led to this, which is this interview, which is I don't normally read Yahoo Finance articles.
Yeah.
I find that they just recycle articles once every 5 weeks or so, and other outlets do the exact same thing. But anyway, I decided, just whatever, open on my Yahoo Finance app, and it was something like five cover call ETFs to be aware of. And the top couple were those old dinosaur Radio Shack funds, QYLD and XYLD. Hopefully you're not friends with those guys. Anyway, and then anyway, at the bottom there was T-Spy. So anyway, it led me down the rabbit hole of getting into. I'm always excited to explore new funds and really dig deep into what they're all about. Can it fit my own strategy? Is it something I can talk about with my own audience and bring this kind of these funds to light that maybe deserve to be brought to light. Um, I did want to. I have a couple of Patreon subscriber questions, so
Mhm.
I'll also cycle into some of those. But one of them I wanted to ask you is from a Patreon member. How does this fund differ from other zero DTE funds like XDTE, for example?
Yeah, couple ways. Number one, the way that we implemented the fund, we actually own real shares of SPY. And so that's one big differentiation. And we fought hard to actually like get the implementation to work because it's a lot more challenging, for the from the implementation side for custodians and banks to sometimes work with real shares to collateralize it versus doing swaps or synthetics. So that's one big difference. Number two, our fees are about 40% less than an XDTE. And then number three, our yield, our goal ultimately is, we're doing true zero DTE, which means you write it in the morning and it expires same day. There's not that many. I think XDT is one of the funds. There's others that do actually one DTE, and there's a couple of reasons for that. But going back to owning the underlying shares, we want to have a balanced approach to these funds. So there's income plus growth is really our goal. It's a balanced fund. Some of the other funds that are higher yielding, you're trading off the growth part because you're actually scooping out all of the yield and distributing it now instead of actually leaving it in the fund to compound and grow for later. And so TSPY is really focused on a balanced approach for that. And one of the reasons is, and again, I'm not an accountant, but something to ask your sort of tax folks. One thing that's really powerful about ETFs is they have this magic thing called in-kind redeems. And when you have a hedge strategy like covered calls, one of the things that a lot of people don't know, and I got hit by this when I was doing this in my own individual account. When you take a straddle position on underlying shares that you own, you effectively pause the long-term capital gain clock on those shares. So if you buy a bunch of SPY and then you're doing daily covered calls on it, even if you hold the underlying SPY shares in your individual brokerage account for more than a year, potentially when you sell those, you have to pay short-term capital gains on the growth. But if you do it in an ETF, and again, not a tax accountant, but something to ask your accountants about, those shares actually go back to the bank in kind if you sell a TSPY share after 12 months. And so all that our investors have to pay on the capital growth of the underlying SPY in those cases that stays in is deferred long-term capital gains. And so when you do that kind of thing over a 10-year period, the amount, and you have identical growth to two different funds, but just the tax treatment is different, you end up with significantly more after-tax capital if you can implement it in a more tax-efficient way. So that's one thing to explore and a big differentiator for what we're trying to do in TSPY. And then, back to your point, what makes us different? TSPY as a true zero DTE strategy, we write it in the morning and it expires the same day. There's three really big benefits to doing a true zero DTE strategy versus a lot of people do covered calls over a week or a 30-day or even longer. Well, let's say the biggest one is, let's say you do a 30-day strategy where you write one call over 30 days and it's at a certain risk level. One measure of risk could be delta, right? 25 delta or less, you get paid X in premiums over one position over 30 days. But if you do it the same risk level, so 25 delta, but you just do it every day over that period using zero DTE, guess what the premium multiple is for the same risk if you do it that way versus with one 30-day position?
I'm sure you're about to tell me.
It's between 4 to 5 or 4 to 4.5 times the amount of premium for the same level of risk.
Wow.
So when you're talking about risk-adjusted returns, I'm crossing a moat on a thin bridge, and the reward, the bag of gold on the other side is a small bag, or I'd see a bag of gold for the exact same risk.
Yeah.
On the other side, that's 4 times as big. Which one am I going to take? And so when I was deciding how to implement this strategy back before we had an ETF, I did the math, I did the comparisons, and I was like, wait a minute, why would I do a longer dated one? And there's some drawbacks, right? So one thing you've got to control is commissions because you're doing stuff every day, right? It's 22 trading days, so 22 times the potential commissions. Yeah. Except in TSPY, we actually ended up using index options. So SPX, for example, and that has 10 times the notional value. And therefore, we take our potential commissions and we're saving 80 to 90% on the commissions because we're able to actually sell many fewer contracts because it covers much more. So that's sort of advantage one. Advantage two, markets move and you can't predict it. And so if you have a 30-day position, you're kind of stuck. But with zero DTE, every morning you can actually reset where your strike is. And so you can much more closely match the movements of the market to keep your positions within the desired risk level. And then number three, that people don't think about that much, overnight risk is real. There's a lot of movements that happen overnight. So with a true zero DTE strategy, you skip things like, oh, NVIDIA has earnings after hours, or Microsoft or Amazon, or there's a macroeconomic report that comes out in the morning. Well, if you have true zero DTE, you skip those movements, your underlying SPY shares capture it, but you don't have that risk with your options position, and it makes it much easier to mitigate risk when you're managing your portfolio like that. So those three things made it really compelling to get good performance, to get better benefits, to more closely match the risk profile of, I originally built this for myself because nothing was out there on the market when I was looking at this, but low to moderate risk folks that have a longer term time horizon that are looking to get more income out of what they have. That was the whole concept, right? Tap the potential of what you already got versus actually trying to do anything different.
That's you know what? I haven't had the zero DTE. I haven't heard it explained exactly like that, which is brilliant, actually, right? Like you said, you're for a portion of that or for the income generation tool, eliminate that overnight risk and then you're just I mean, you're only dealing with the whatever it is, the 7 hour window. What I mean, as long as markets are open for. So that makes it, I suppose, I mean, even though zero DTE, the strategy has only been around for a couple of years. I mean, like we're seeing so much more of it. And I mean, I'm sure it'll probably put, everything else, kind of, for lack of a better word, out to pasture, over the long haul. I mean, that makes me think like I mean, why wouldn't other fund managers adapt to zero DTE if zero DTE fund managers are pretty much now only constructing these types of funds, or is it just too new? So you have like sort of the like legacy institutions that have their giant AUMs and the same strategy over and over, not really innovating, and they don't care because they're making bank off of their billions in assets versus the more nimble fund managers that have a lower AM that are, hungry for, innovation in the finance space.
I think you hit it on the head. It's emerging fund managers. I think there's some studies on it. I can't quote any right now, but emerging fund managers, because they have to innovate to compete,
Mm.
have an interesting performance edge, and zero DTE options are brand new. I've literally been doing them since day one, but
Right.
it's just, I mean, it is a lot of work, and that was sort of the genesis of why we built the underlying fintech, just to do this thing really well. Zero DTE covered calls, and I actually built it also. I was testing cash covered puts as well on short term basis, and the technology just does that thing really well. But that's what enabled me to actually like bring something to market because it's very hard to manage daily, positions, especially for example, if you're an advisor. Let's say you have 100 clients. How would you ever scale trying to manually manage a daily
Right.
strategy for any of them? And
Oh, goodness
so
me.
that's long-term, game plan is create this capability, prove the success through an ETF, and then long term we'll probably do a couple more ETFs to make sure we can cover the parts of the market that need attention. But we can license out the underlying technology to help advisors and individual investors manage their own positions. But it just makes it so much easier if you have some tools to help you do
Hmm.
it.
So basically, TSPY and maybe any future funds that come out is essentially a proof of concept for, like you said, the underlying technology that runs these ETFs. I
In a way, yeah. What's great about ETFs that I love is the transparency. That's
yeah.
a really important factor for any investors. Just you got to know what you're getting into. And ETFs naturally through regulatory pieces, and we actually try to go above and beyond of what we're required to do to actually show transparently exactly the positions we take, exactly the kind of distributions that we're doing. But since it's all public and it's out there, we can show, hey, just look at the performance of T-SPY versus the S&P 500, and you can see it every day in real time. So you can actually see, hey, this is actually something that's working, or it's something that underperforms. We'll see what happens based on market conditions, but then you have all the data as an investor to make your own decisions. And that can be a really powerful tool for us long term to help scale. Our goal is to add value at different places across the chain. And once we can prove the use cases, then I think sky's the limit.
Perfect. The next question I had just had to do with the distribution. I know I believe it was October 3rd was your first distribution.
That's right. Yep.
And it was, call it, 29 and a half cents roughly, right?
Yep.
And that is leading to a 12-month forward yield of 14, maybe as of like market price today, maybe it's like right on 14%. I think on your website it's 14.19, but it's that usually I take it that information is delayed by 1 day and then gets updated. So, but anyway, we'll just say 14%.
Mhm.
Um, do you expect that distribution to be released on a monthly basis within a kind of in a narrow band, or do you expect more, say, volatility in the variability of when these distributions come out?
Yeah. Our goal, I think ultimately our goal is to try and be consistent. And full transparency, like the actual distribution amount was a big debate that we had internally because, and this is a really important thing for income investors to understand, distributions have different components that actually contribute to what that distribution amount is. So 14.2% on the NAV of the day that we actually did the distribution was what the target was. And so that's what 1.18% of actual distribution that went out to investors.
Yeah.
But one thing that's really important for people to understand is that different funds, when they do, you've seen some of the competing funds that are pure income funds that are distributing 25, 30, 40, some of them are up to 60 and 70%. You got to wonder, where's all that coming from? And so, and not no end of the spectrum is good or bad. It's just what's best for the individual investor.
Mhm.
And so trying to bring transparency to that so people understand, all right, we distributed the annual equivalent of 14.2%. The makeup of that was options income, plus there was a SPY dividend that came in that window, plus there was SPY capital growth, and then the last bucket is return of capital. So we were like, we could perform the exact same way as a fund, and we generated, I think we generated like, don't quote me on it, but like zero point 0.6, the equivalent of like 7 to 8% of additive annual income on top of the SPY. But again, we'll go do the math. But if you're generating that, you can actually distribute different variations in yields, right? So anyway, it's important for people to understand where the yield comes from. So we were debating, do we just distribute the options income and SPY dividend, or does the market want more from a sustainability perspective? And so we actually decided to take a more balanced approach. So instead of just income, we ended up delivering income plus a little bit of the SPY growth, and that's what got us to the 14.2% yield. So it was a really um, it was a deep thought process, a lot of conversations to help get us there. But long term, you can take the same performing fund and actually create a spectrum of different sort of distributions in order to meet the market demand.
That's good, awesome to hear. So maybe just to, I take it that not all funds, like, I mean, if you're investing for income into an income fund, you're obviously, number one, you're doing it for the income. Will TSPY is essentially maybe the easiest way to think of it. Are you trying to get max performance at the same time max yields? Like it is like basically the highest equilibrium that you can possibly get between the two, or is it simply, naturally it's an income fund, so income first, then essentially the capital appreciation after that?
I think we have a dual mandate. I think it's looking to deliver both income in order to help bridge the gap, like in my situation,
Yeah.
plus long-term growth. So it's really for, I mean, it's for folks. Think about the phase of life that you may be in as an investor. If you're still in the phase where you're filling the balloon full of assets, or you're in the phase that you're emptying the balloon full of assets. And for people in a certain age category with a certain timeline, um, I'm still filling the balloon, but it's actually helpful if I can generate more income. And the other thing too that I'd love to try and do is, since we're doing dailies, like, can we have a shot at beating the S&P even by a few percentage points? And you compound that over time, and that's a huge difference.
Yeah.
So for us, we're taking a really balanced approach. And my whole philosophy is, look, if you don't need the money, you don't need the income, don't take it out. Leave it in so that it can compound and grow over time. So we left of the SPY growth of over the first month and a half, 80% of that growth we left in the fund in the SPY shares, which means there's no tax implication. And over time, that money is working for you in future months. We took 20% and pulled it out with the options income and distributed that. And that was the balance that we felt was right. Also to try and match what we're hearing from the market. So time will tell. Really big decision to make and a big debate we had internally, but the goal is, um, try and find a really good balanced product because I think there's room in the marketplace, and I think there's demand for that versus just being a pure yield product.
I mean, I can certainly agree and wholesale advocate for that. My own personal strategy that, as long as I've had this channel, I've been talking about, and that truly is how I try to run my own portfolio, which is very much a balanced approach. I don't currently need the income, but I will by next year have a tangible use case for it
Mm-hmm.
from one particular account. So that's why TSPY, even for myself, is very interesting of a fund, maybe more so than usual simply because of the fact that I do try to, how do I get that maximum capital growth along with maximum, yield as well? On a personal experience level, as an investor, what I'm finding is I would say year to date, because I release it on my community tab every Saturday, I post just how my portfolio is doing. Once again, transparency because integrity and honesty really is the currency of trust. And
Yes.
so if people want to follow the channel and they really think I'm, it's all bogus. I mean, I post it there all the time. I do YouTube video overviews so people can just see the whole thing for themselves. But what I'm finding is that even my own portfolio, which I don't expect will achieve this in the long run, but I mean, who knows, is actually beating the S&P 500 right now. It's actually beating the NASDAQ 100 right now. It's beating all the indexes, beating the TSX 60 here in Canada, which I mean,
Mm-hmm.
that's a more cyclical index. It's, more energy and financials based, but even to my own surprise, that I'm shocked that that is the case. As far as the yield is concerned, I'm finding about 10 to 12% is kind of that sweet spot where
Perfect.
you can you get sort of the best of both worlds. And I mean, you know what? I mean, no, at some point in time, we're probably going to experience another big hit to the market, and having funds that have the ability to naturally grow, even if it's a bit slower, because right, I mean, cover calls, they have a drag on the price of their unit costs. But if it's still able to grow back, I mean, I think that is such a huge psychological win for the average retail investor out there versus say maybe perhaps higher yielding funds. And I mean, ultimately, yes, total return is the most important measure of it, of course. But I do think about that the psychological impact of what that might do during a down market. So yeah, I think it's quite an interesting fund from that perspective. So I do look forward to see how it does, over time once we get, 3 months out from inception, 6 months out, 1 year out from inception. One other question I had was another subscriber on my Patreon, their question. Uh, I know you're doing monthly distributions.
Mm-hmm.
What about potentially doing weekly distributions? Was that ever in the conversation?
Yeah, it was, and still is. So I figured first step would be, let's try and tune the distribution number. 12 to 14% was exactly the range that we were shooting for. And then I want to see what the market says to us. If they're assets that are coming in, a lot of feedback that's coming in that says this is be really helpful for income investors to do it on a weekly basis, that is absolutely something that's in the conversation. So we'll likely keep this month where it is, and then before the next distribution, we'll revisit that conversation based on what the market tells us and see if it makes sense to make a switch. But yes, absolutely, it's in the conversation because there seems to be a lot of demand from income investors for a more frequent distribution.
Sounds great. One other question I had for you, is there, in my mind, I have a fund in mind that is maybe, I guess, the closest or the most similar. So I just kind of want your reaction to this. Is T-SPY the next SPY-I?
Great question. And Neos, I love the stuff that Neos has been doing. And when we're trying to figure out where in the market we want to be, SPY actually seemed like a natural sort of space in the marketplace. The main difference, if you look at it, like I think we're matched on fees to
Okay.
the basis point, which was just a random fluke. We are beating a little bit on distribution, and then I think one of the biggest differentiators between us and I don't think SPY does dailies. I think they have a longer dated option strategy. And so
Okay.
you can look and see in markets that are going up, as it's been since our inception on August 15th, dailies just inherently have a more responsive characteristic. So you can kind of perform a little bit better in those up markets. So doing those comparisons, I think, is really important for investors to look and see based on what they think their outlook would be, what's a better fund match. But I think SPY is a really natural kind of adjacent fund that we're looking to sort of be in the marketplace for that, but as a zero DTE version of it, owning the underlying true shares of the S&P 500.
Yeah, that's actually another thing that I wanted to point out that I know you've mentioned a couple times, which is actually another favorite quality of mine, the fact that you actually own your underlying. It really speaks to the whole, when I got my start in investing, reading a lot of Warren Buffett type stuff and watching a lot of
Yep.
Warren Buffett type videos, and he would always make that comparison of, if you're going to own an asset, it's like owning a farm, and what's that farm producing for you? And I always
Yes.
just thought that was a very simple analogy. That's always just stuck with me. And so basically, one of the things I do is just the way I narrow down what I actually want to invest in is just figuring out what I kind of want to kick out, like it doesn't use up too much, space in my brain to consider, which is just the things I don't like
Mhm.
or that don't really fit the mold or don't really fit my the parameters of how I invest. So for me personally, something that acts like a farm, like Warren Buffett talked about, you know what? I'm all for that. So, and I do believe that seems pretty rare for a zero DTE strategy. It's that most of them, like you said, there's more bureaucracy, I suppose. So, maybe creating a synthetic cover call, and I know there might be a bit of the audience might not understand what a synthetic is, but I guess simply put, it's giving you exposure to the price of the underlying asset, but not the actual asset itself. Is that maybe the best way to put it?
That's a great way to explain it. And what's also nice about truly owning the farm, aka owning the shares,
Yeah.
not only is there a potential tax benefit because of that in-kind redeem in a ETF. Second thing is, whenever the S&P 500 or the SPY pays its dividend, funds like TSPY that actually own the underlying, we're paying it right out. So you're not actually sacrificing even the dividend gains from coming and being a part of your income on a quarterly basis, just like owning the SPY shares itself. That was a really important thing to me because I loved owning the actual SPY shares and I owned it for a long time. But I was doing this, to the farm analogy, harvesting small bits of option premium every day as part of the output. And I wanted to wrap all of that in an ETF and provide it to the market for other investors that thought in a similar vein that I did. And that was hard to bring to market, but it really was something that was important to us from a tangibility perspective.
how long did how long did it actually take from, you had the underlying technology to launch day in August of this year?
It was a process. We started in November of the prior year.
Okay.
We were hoping to get, I was like, the SEC process is probably going to take time. Didn't take time. We could have, had we had the right um, implementation and implementation partners by, earlier in 2024, we could have launched earlier in the year. But as I mentioned, we weren't able to launch until finally August 15th.
Mhm.
But like any challenge or any adversity, the thing that we ended up with afterwards was so much stronger and so much better because we went through this process and we were able to, what we were going to originally launch with, there was a risk from a potential taxation perspective and a commissions perspective that it was going to be less efficient. So we ended up tuning in what turned into TSPY. And now there's two pieces of value. There's the options income and there's the underlying share growth. And we have optimization with SPX as uh, what we're using as an index option. And
Mhm.
it's potentially much more effective 60/40 from a tax perspective. And then now owning the shares has potential to really benefit from the tax perspective too. Again, talk to your own accountants, but we were really, really pleased with actually getting what we did to market and the operational piece and being able to do what we're doing every day. It's hard to be nimble in a fund. So you're a covered call expert. One of the tools that we use to be defensive is, for example, let's say you have to roll your option to the next day. Well, if in a lot of funds, it's really difficult to be dynamic, but we have that capability because of how we implemented it. So I'm really happy with the end product that we ended up with, but it did take us from November of 23 till mid-August of 24 to get the product to market.
Well, it's great to see you kept up with the hunger for it because, yeah, almost, I mean, not a year later, but man, like 9 months or whatever it is,
It took
later.
time. It was we were really, it's hard because you always hear in the ETF industry, you got to be first, got to be first. And in our case, like I'm glad we were right in what we built and brought to market. And in a way, like we're unique still in the marketplace compared to some of the other funds that are out there that are doing zero DTE. So bottom line, I think we've got a lot of upside. And I think the key is performance is going to trump all. So let's watch and see how things shake out. But I'm really happy with where we ended up.
For sure. So I got a couple more questions for you,
Sure.
and then we'll sign out here. Once again, thanks for joining us for this. Um, One thing I know income investors they want to know, especially those who are a little bit more engaged in it,
Mhm.
they like to know the portfolio coverage or the cover call writing percentage on the portfolio
Mhm.
and the moneyness. Those are the two things, this community who's engaged, they really want to learn. They come back video after video, I can tell. And that's definitely two things that if I didn't ask, I'd get shellacked in the comments for not asking it.
Yeah, great question. So regarding, let's start with the coverage. We want to make use of every dollar and every share that we have in the SPY.
Mhm.
So of 100% that goes in, about 99% of it is invested directly into SPY shares. We
Okay,
keep a little cash on the side just for operational reasons. It adds a little convenience to make sure we can operate efficiently. So we want to be dollar for dollar owning the SPY. And then we're looking to cover up to 100% as close as we can without going over of the SPY shares that we have. So that's one of the things that we wanted to do on our website. um, we publish our intraday trades, and you'll see we end up buying as much of the SPX to cover. And then even there's a little remainder sometimes. We try and cover the rest with the minis, the XSPs, because we want to make sure that we're making use of every share to help generate income for investors. And then the second question, the moneyness, our strategy is dynamic. I'll answer it in two ways. Number one, the ranges out of the money that we typically will position it. Sometimes it's 0.4, maybe a 0.5% out. But if it's a highly volatile day, like let's say Jay Powell is speaking,
Mm.
sometimes we'll go as far as 1.5% out. Our fintech takes all these inputs in and in the moment, in real time, actually tells us, hey, this is within your risk reward profile. This is the risk that you take. This is what the reward would be from a premiums perspective. So we can decide dynamically, and the fintech helps us do that. I usually, and then the other measure that people sometimes like to talk about it in is delta, like how far of a delta. We're typically 25 delta or less, meaning we're pretty, moderate to conservative in where we put our strikes. And the reason is we want to capture most, if not all, of the S&P 500 growth and add that income component on top to be, truly additive total return product.
Gotcha. Maybe just to add on to that, just because I don't I don't want the audience to get confused by anything here, but I think when we hear things like there's 100% coverage on the portfolio, I think there is this natural tendency to think that, oh, it's 100% covered. That means that there's no capital growth whatsoever. So maybe
Oh, yeah.
can you maybe just elaborate on that just a little bit better for the audience that might think that just to maybe separate like, well, then how does it actually grow if there's 100% coverage on it?
Yeah. So coverage is just of the value of the shares that you have.
Yeah.
What percentage do the options contracts correlate to? So if you have 1,000 shares of SPY, when you say what percentage covered are they, do you have 10 contracts of options? And so that's the correlation. But the space, the headroom for growth on a daily basis is a totally different dynamic. And so that's the moneyness that you sort of talked about. So if a strike is at, call it $500, or sorry, if the stock price is at $500, we're usually selling calls at maybe 510. So you have a $10 growth potential from a capital growth perspective, and you're collecting the option premium by selling that option at that space. But that space is what allows you headroom to grow the long-term capital growth of the SPY. Does
I
that make
see.
sense?
Yep, no, you know what? I definitely I get it. Um I know up here in Canada, a few of the fund managers up here, I guess what they'll do is they'll put in their, strategy objective. They'll say something along the lines of like, we'll write 33% on the portfolio with like within that 33% portfolio coverage, they're going to be, call it 2 to 5% out of the money. So there's still growth
Mm,
within that the writing coverage, and then the other 66 and a bit percent is just whatever the market does. So
mhm.
that's just what the difference was. So basically in this case, the actual growth is coming from the moneyness perspective.
Moneyness.
Okay.
Correct.
All
Yep.
right. So I get
Exactly right.
and anyway, if there's anybody in the audience that's still, I think that explanation was good. But if
And
anyone still has
hopefully,
questions, hit me up in the comments.
no doubt. And I think the key is to look at total returns. So there's different graphs to look at, but
Yeah.
always look at the total returns of a fund and compare it to the underlying index. And then you can kind of see, are you able to capitalize on that headroom or not? And if you're running low on total returns and the S&P index is higher, it's because your moneyness is too close or your coverage level is too high. And so you're not actually getting the full potential of capital growth, but you're trading that off for income. So that's an easy way to sort of check, are you allowing headroom for growth?
Right. And certain apps like even like Yahoo Finance doesn't give you an actual total return, but Seeking Alpha does for free. So
Yes.
I mean, if you guys want to check out total return, go to Seeking Alpha, compare TSPY to say, VOO or the actual SPY itself, I guess. And then you can actually get the total return for total return comparison. Very important there. Last question for you, Sai.
Mhm.
Again, it's come from a Patreon member. You kind of lightly touched on it, but we have a member just is curious about. Future launches, do you have other tickers that you're coming out with in the near future? What might future products look like from sector specific cover call ETFs to maybe like do you have any plans for maybe higher yielders, like not necessarily the balance growth to income ratio? Maybe if you could touch on that, if you can speak about it.
Yeah, we actually, because of this knockdown, drag out debate on like where are we going to set our distribution number,
Hmm.
we realized like even with the exact same strategy of the underlying activity, we could potentially put out three products attached to it to make different parts of the market happy. So you could have the same total return product and do what we're doing now, which is the balance approach and yielding 14.2%. But it also makes sense to take the same performing product, which we're trying to optimize, and do two things. One, let's go to the far left where you have a long time horizon, where you only distribute the options premiums and you leave everything else in the fund. So that's like a 7 to 8% yield. And then we have another potential product where you take not only option premiums, but you also add the SPY growth. And then you can create a 25 to 35% yielding product. So 7, 14, 30 on the same total return product. And then you can sort of choose what's the best fit for what you need as an investor. So that's one thing that we're talking about. We want to prove the concept with TSPY first. But if the market says, yes, this is hitting a sweet spot and there's other demand, then it makes sense to do a weekly distributing 30%, income fund.
I see.
We absolutely are thinking about doing that. So that's one dimension. And then the next dimension is taking the same strategy and putting different securities in. So a second fund that we've already registered for is called TDAC, which would be the same strategy on the NASDAQ 100. And then we reserved one for TRUS, which would be the same strategy on the Russell. And then we can use other indices too for, Mag 7 or whatever the core underlying security is. But our secret sauce is going to be taking that and amplifying it with this daily covered call fintech and scaling a business from there. And then long term, I'm known for bad analogies. So TSPY is like, you're buying the cake fully baked at the store and you're getting full benefit from it, just, benefits delivered directly to your brokerage account. But then long term, let's say you want to bake your own cake at home, but it's got that secret sauce. We would make the fintech available so you could basically connect it to your brokerage account, or if you're an advisor and managing multiple clients, you take TappAlpha's fintech platform and you plug in any security and have it help you automate this option covered call strategy. And then you're adding more value to your clients, you're adding more value to your own portfolio. And that's the whole idea of TappAlpha, right? Tap the full potential of what you already have. All you have to do is have the right tools and the right education to do so.
Perfect. Yeah, love the explanation. Thank you for talking about, potential, potential future funds. Typically because I spend a lot of time in this world, in this, the income world, not all, it seems all fund managers are, they don't want to give clues away to what they might be working on, but, and even just the tax, even some of the tax talk, which, I mean, for your side of things might not necessarily benefit us Canadians up here, but for the American audience, I mean, I think, that's definitely something to rewind and play back just to get the full explanation once again. So, you know what, Sai, I really appreciate just the content, the expertise that you brought to this talk. I'm really excited for TappAlpha, excited for TSPY. I think it's certainly a really unique fund. I'll be watching it very closely. I'm certainly in the marketplace for an American cover call ETF that has, the best of both worlds. Like I said, I've so look forward to it, and maybe I'll hit you up to let you know if I eventually do invest in TSPY.
Excellent. Anytime and any other questions come up from your viewers, happy to answer and just really appreciate the time and always love talking about it. So thanks so much for having me.
Absolutely. All right. And just for the audience, if you want to get a hold of, well, or maybe in contact with the people from TappAlpha, just head over to their website. I believe is it simply just tappalpha.com or
We have
tappalphafunds.com?
Yep, we have both TappAlphaFunds.com. You can directly message and it'll come to our team. And that's got all the fund information as well. So that's usually the best place to start.
Okay. Either way, I'll put a link in the description, everyone, so you can get a direct link right there. So once again, thank you, and for the audience, as always, hopefully you enjoy what you saw and hit all the buttons of the like and subscribe variety, and I'll see you all in the next one.